Good morning, everyone. This is Jim Landman from Kaufman Hall's Thought Leadership Team, and welcome to our Spring Rating Agency Update. Today's webinar will be moderated by Robert Turner, a Managing Director and leader of our Treasury and Capital Markets practice, and Lisa Goldstein, a Senior Vice President in our Treasury and Capital Markets practice and a member of our Thought Leadership Team. We're happy to take questions as time permits. You can use the Q&A function to submit a question at any time during the hour. And now I'll turn the webinar over to Robert and Lisa to introduce today's panelists.
Good morning, I'm Robert Turner, as Jim said, a Managing Director and Practice Lead for Kaufman Hall's Treasury and Capital Markets practice. I'm joined today by Lisa Goldstein, a Senior Vice President now with Kaufman Hall. We're joined by our distinguished colleagues, Eva Bogarty, Associate Managing Director at Moody's, Susie Desai, Senior Director at Standard & Poor's, and Kevin Holleran, Senior Director at Fitch. We want to thank each of you for joining us today. We started the quarterly webinar series with rating agency analysts several years ago during the outset of COVID. And while the threat of COVID may be waning, its aftershocks are several. Inflationary pressures, particularly as it relates to labor and supplies, rising interest rates, capital markets volatility. Add to this the geopolitical uncertainties related to the war in Ukraine, and you can see that there's lots to talk about. We continue to face a variety of complex business challenges. Now, you may also notice that I'm not Terry Wareham.
And I am not Eric Jordahl.
There's nothing wrong with your TV. Lisa and I are excited to have a turn at the wheel, and we're looking forward to today's conversation. With that, I'll turn it over to Lisa.
Thanks, Robert, and welcome everyone. Welcome to our distinguished panel today. The first topic that we'd like to cover is outlooks, sector outlooks. And for the first time that we can ever remember, we have three different outlooks on the not-for-profit healthcare sector, and one is not positive. So Moody's has a negative outlook, S&P has a stable, and Fitch has a neutral outlook. I'd like each of you to just spend a few minutes telling us what that means. And Kevin, with neutral, let's start with you. Can you explain what that is conveying?
Absolutely. First and foremost, thanks for having us. Glad to be here. Hope everyone is well, and please send your questions in. We would love to answer them. So, yeah, I don't know the last time any of us were positive, by the way, or if we'll ever go there. So you pretty much have got two to choose from, neutral or stable and negative. But when we approach the year, we tend to get these out very early. And our look, when we were looking at 22, is a prediction of what we think is going to happen, obviously. We decided to sort of break it down to, well, how does it compare to the prior year? We definitely weren't going to be positive or better, and we really didn't think it'd be worse because we had vaccines, and there's a pretty good uptake on that, but that stays the game, better treatment patterns, all of the kind of things that would go into it. So we decided, compared to last year, probably a neutral is the right phrase. And you could look at it as stable if you like, but we really felt this was going to be a transition year, the big transition being from pandemic to endemic, and everything that's associated with that. No, we did not really plan on Omicron or son of Omicron as it's rearing its ugly head right now. We didn't plan on a return of the Cold War and a war in Ukraine. So there's a lot of other things going on that are now being thought about in our look. But we basically said the driving theme, at least us, for healthcare is going to be how do we manage sort of that new world order of an endemic COVID release, if you will. And that really is the basic thrust of the whole thing. We do, as we said before, we kind of ended up a balanced number of upgrades to downgrades. And I know we'll talk about a lot of these things later, but I'm excited to kind of tell you the year-to-date numbers. I'll hold on that for just a few minutes. And I think when I get there, that'll really define what I mean by neutral.
Okay. All right. Susie, stable.
Yeah, and just to clarify, when we talk about our sector view as stable, it's where we think the ratings are going to be headed over the next year. So while we know, obviously, we're going to talk about a lot of the pressures that we're seeing, and certainly some of the things that Kevin brought up that we weren't expecting as well. Our sector view is stable given the strengths of the balance sheets. They continue to be very strong coming into 2022. Expectations of demand for services, as you know, what we saw how that happened when the surges waned a bit. You know, some lingering benefits from the government support, but which is obviously waning. and management actions that, as they reacted and to the changes and the challenges over the last couple of years, that certainly they were able to manage through a lot of challenging times while still focusing on strategy. So just the overall resilience of the sector certainly helped, and some of those other items that I just talked about were leading into that. And we'll talk a little bit more about sort of the upgrades and downgrades and how those worked and factored in and some of the outlook. So we, certainly there are a lot of pressures that we're seeing, and we'll talk more about those. And pause there and hand it back to you.
All right, very good. I'm going to pick up on one of the threads you mentioned, but Eva, Moody's,
yes.
Go ahead.
Yeah, and
Welcome.
thank you
Welcome
all.
to the family. Yeah.
Yes, thank you for having me. Hello, everyone virtually. Look forward to meeting everyone in person soon, but really appreciate being here today. So thank you. Yeah, so Moody's negative outlook really speaks to fundamental business conditions, what we saw coming for 2022. I can't claim, as Kevin said, to have foreseen, we can't have foreseen the Russian-Ukraine conflict or the incredible surge of Omicron. But what we did see was extreme expense pressures with nursing and labor shortages, and very, very choppy revenue, recovery and ups and downs. And then you layer in supply chain issues and inflationary pressures, resumption of sequestration, repayment of MAP. And so for us, what it comes down to is we basically were forecasting a 2 to 9% decrease in cash flow. And for us, that is, pushes to a negative outlook.
Got it. Okay. So it sounds like, Eva, from your perspective, you have a not-for-profit healthcare sector outlook. Is that a Venn diagram, if you will, with how that may inform and influence assigning of bond ratings? In other words, negative outlook, does that mean more negative outlooks on debt ratings or lower debt ratings than if it were, say, stable?
I love this question as a former author of many of our outlooks. It's like features first and foremost on all of our webinars. Not really, I would say. You have to take them apart. The outlook is the fundamental business conditions of the sector. What do we see for the healthcare provider industry out there for the year? It is separate from the ratings. I know we'll discuss ratings last year. We do view the sector as very resilient, so it's not speaking to a lack of resilience, or it doesn't discount the balance sheet growth. Ratings really speak to how the hospital is operating in this fundamental business condition and how it's reacting. The outlook of the rating speaks to how it's reacting and where we think the rating will go, but it's a different subject.
Okay, got it. Susie, something you said would lead one to conclude that it's more intersected with S&P having a stable outlook on the sector. So to what degree does the stable inform rating assignments?
Yeah, like I mentioned, our sector view is where we think credit ratings are headed, and certainly they're impacted by what we're seeing from the healthcare trends in the sector, for sure. But as I mentioned, we think that there is given some of that strength coming in, that with the with uncertainty, that there would be some ability to manage through this year, with on balance ratings kind of remaining stable. There will of course be ups and downs on individual credits, depending on certain circumstances. Not everyone's obviously the same, and certainly outlooks could change depending on what we're seeing too. But on balance, we think that the ratings will hold, and we won't see too much up and down in any direction, one way or the other.
Okay, so maybe more of a Venn diagram, if you will. And then Kevin, neutral. Is neutral going to be a new debt rating outlook, or does it influence where you might come out on ratings themselves?
Yeah, it doesn't influence our ratings at all. So if we're, again, positive, stable, neutral, negative, it really doesn't look at it. It's a result of what we think is going to happen, obviously, but doesn't influence, wow, should I be positive or stable? It better be stable, because I said no, that never happens. Similarly, a real similar question that you didn't ask, but there's a common misconception with medians as well. So we don't really rate to medians. Medians are the result of the ratings. They don't drive the ratings themselves. And I think it's a common misperception. So it's the same really with our outlooks. We're as Eva said, we're trying to predict what the environment looks like, how's it going to be for that 12-month period, and has really no bearing themselves on the actual rating outcomes.
Okay, got it. So speaking of ratings, we've all mentioned them. To us, 2021 was remarkable in terms of rating activity in that all three agencies had more upgrades than downgrades. Moody's 10 up, 5 down, S&P 21 up, 20 down, so very close. Fitch 17 up, 12 down. So a bit of a head scratcher when you think about Delta, Omicron surges, going throughout the country. Everybody likes an upgrade, but what does this tell us? What does this tell us? Eva, do you want to start?
Yeah, I mean, I would say looking over our 10 upgrades, they were decently positioned going into the pandemic. And so you're really seeing them play out on the initiatives that they've been deliberate about. You're seeing, great management teams delivering on strategy, adjusting as they need to, and just pulling apart from their peers. So for us, that was really the upgrade situation. Of course, there were some, mergers and acquisitions and other things mixed in there, as there will always be. But it was really that ability to, stay the course and deliver on strategy despite the pandemic.
Do you have first quarter activity?
I do have first quarter activity. It is even through March 31st.
Okay.
I don't know if now is the time to say what we see for 2022, but I would just say, even among the very strongest, it was a really tough first quarter of the calendar year. So I would predict a tempering of our upward motion this year.
Susie?
Yeah, I would say the balanced activity really helped inform our sector view for over the last year. And again, that sort of resiliency and demand. The ratings that were up, a few of those were M&A, like Eva said, similar to up for us as well. And the ones that went up, they were performing positively for a number of years, well positioned, strong before COVID. And usually, even through COVID, we're not dependent on provider relief funds. So really kind of weathered that well. And and I would say most of those upgrades were kind of in that A, BBB kind of range. The downgrades, we had some negative outlooks out there for a number of years, and it just, continued to remain pressured. And there was maybe one or two due to debt reasons, but other than that, it was more operating and balance sheet weakness. And I would say on the upgrades too, on the financial profile side, it was generally both the balance sheets and the operations contributing to those upgrades.
And year to date?
Yeah, our unofficial, the account has been also even with 4 upgrades and 4 downgrades. So.
Got it. Okay, thank you. Okay. Kevin.
Yeah, if you look at 21, you have to actually go back to 20. And in 20, I don't have the numbers for everybody, but I certainly know we had more downgrades than upgrades. The number I always say publicly is 17 downgrades, 5 upgrades. You could count it a little bit differently and add more downgrades, but if you were multiple touches, if you will, throughout the year. And if you look at our book of business in 2020, there were a whole lot of positive outlooks that we just sat on, quite frankly. If you read the report carefully, it would say, but for the fact that we're in a worldwide pandemic, I would have upgraded you, sort of a thing. Mm-hmm. And really, when you got to 21, a lot of those got resolved, quite frankly. And so we found out this pandemic was livable. It was doable. By the way, vaccines are out there. And we all saw, last summer where things really flattened out. People went on vacation, took the masks off. Life was getting back to normal. And you saw a lot of those resolutions take place. We had a little bit more upgrades and downgrades, but not by much, pretty level from our perspective. The year-to-date number, and I did want to spend a second on this, and I'll give you 2 data points. Over the last 6 months, we have had a shockingly small amount of activity. 4 upgrades, no downgrades. And over the last quarter, 1 upgrade, no downgrades.
Okay.
And I can't think of anything more neutral than that. Almost no activity, basically speaking. So again, did not create this to validate my neutral in any way, shape, or form, but the way it's sort of panning out is it's very milquetoast so far. We've already talked about high balance sheets. That's giving a lot of people a lot of leverage and a lot of rope and a lot of time to weather the storm. And we certainly know this first quarter, as the numbers start to come in, is looking very, very tough. But we think the summertime will look better. So neutral, if you will.
Okay.
Well, so let's pick up on that, Kevin, because I think as we start to turn our eyes ahead, right, I think labor is on everyone's mind. And we know each of you's commented on the challenges in the labor market. I know we're seeing it as well. If labor expense continues to skyrocket, is this an extraordinary expense, a one-time item, or is this rebase our expenses? And do you have any perspective about expectations for when and how this evolves?
It's a good question. And so I don't know who said it. There's a famous quote out there that, trends that can't continue don't. And the reality is there are two trends that are taking place. There is, as you submit, sort of the exorbitant and inevitable move upward in labor expense. I do think we've reset at a higher level, and we'll talk about that in a second. But the trend that it cannot continue is this skyrocketing. So that's simply unsustainable. And again, that can't continue. And look, we've all heard it on the phone, talking to our issuers across the country. How much are you spending on agency? And some of the numbers are outstandingly high. 200, 250, I've heard as high as $300 per hour. Doesn't take a mathematician to figure out that's a $500,000 FTE walking around the hospital, whereas 6 months before it was a $80,000 to $100,000 FTE. That trend can't continue, Robert, because that pricing wasn't built in anywhere to anybody's thinking. And so I don't think that it will, frankly. But if you had to look at the bigger picture and say just in ordinals, if we started at a 1 or a 2, at our worst, we ramp up to a 5 or a 6, I think it's going to level back down at a 2 or a 3. That $80,000 employee is probably going to be a $120,000, $140,000 employee, but it can't stay at $500,000. It's not going to happen. It's not built into it. So yeah, it's a long-term trend. How long does it last? I ask that question to everybody I talk to. The most optimistic are a year. I would say the mean or the median's probably getting around 18 months. But I have more than one person who has said, this is a macroeconomic trend. We've seen it coming for a long time. You can't fight it. Maybe 10 years, it might level out. So we're absolutely going to have to get more creative with how we deliver care and the mix of people that we deliver care with. And so we're talking about some fundamental operational changes in our clinical delivery, not necessarily strategy. We're talking tactical on the ground, if you will. So let me stop there.
That's very helpful. Susie, I'd be curious to get your perspective on this as well. So, Kevin sort of said it looks like we rebase, and be interested to get your thoughts as well. Are we going to get back to 2019 levels in terms of performance, or are we sort of at a different level?
Yeah, and of course, as everyone's mentioned, this first quarter was tough, and hopefully there's some time to recover from that extreme sort of January, February, March, and we don't go on a repeat of that anytime this year. So, from a margin perspective, I think 2022 is going to be tougher. There's less provider relief funds flowing through. The public health emergency is going to roll off. So we do think, from a calendar year perspective, 22 is going to be a tougher year. And then, as we've mentioned, the balance sheets provide some flexibility to kind of move through that phase. But then the question becomes like, how deep is that and how long does it go? And I think there's going to be some unevenness to that, depending on where hospitals are located, what regions, and potentially some of those offsets too. So, labor and staffing, everyone knows about 50% of our costs. Supplies are also experiencing that inflationary pressure. If that continues for an extended period, what are those levers? I think we've heard folks trying to go back to their payers, and potentially there may be some payer relief, over the next few years, but that's just when those contracts open up. But agree that there's probably going to be some, and there may be some opportunities for growth, in certain markets, some other new opportunities, depending on again, services provided. And over time, there may be some technology innovations that start to help both efficiencies and care modeling. So there are some things there, but I agree that it's probably, we've heard all of our providers telling us this is a 3 to 4 year kind of, at least, sort of trend from a labor perspective and trying to grow out of it. But hopefully that extreme kind of agency type of expenses start to lessen, but it will be, elevated. It's just how long and sort of how elevated are the questions.
Yeah. Thank you. That's helpful. Okay, Eva, obviously you can tell where we're headed with the next question. If this is going to persist for the next 2, 3, 4 years, and you look at the pressure that's going to put on margins, are we going to end up rebasing medians? And by that I mean, if AA hospital systems used to have 10 or 12% operating cash flow margins, and now they're going to have 6 or 8% operating cash flow margins, are they still AA's, or has the AA median now rebased lower? Talk about that if you would.
Sure, absolutely. And I think Kevin said it, we don't rate to the medians. The medians are what they are because of the ratings, right? But I'm sure everyone's heard us all say ad nauseum, we rate through the cycle, we rate on an ordinal scale. Those comments stand. If all of the AA's are having 6 to 8% margins, then, it really depends. Then no, there's no reset. It really depends what you're doing relative to peers. And that's where the rating action comes from.
Yeah. Thank you. That's very helpful. Susie, it looked like maybe you were going to say something, or
I was saying, and we look at credits holistically, right? So one margin, one thing doesn't. It's sort of the whole story of, where how much balance. I mean, there's a lot of, for some places, a lot of balance sheet flexibility there for a couple of years of sort of some lower margins. What's the market position of that organization? What have they invested in already that may start to support them? So, it is a holistic view, credit by credit, of what we're looking at, and a forward-looking view, right?
Yep.
Yeah, Robert, I was going to jump into and say, if there was one measure that we at Fitch look at the most, it's balance sheet strength, and in particular, it's cash to debt. That's the one thing you really can more or less control. Are you going to issue the debt, not issue the debt? How are you going to spend your cash? How are you not going to spend your cash? And we say, margins can kind of come and go, but cash, hopefully, everyone, do the sign of whatever you like, stays forever because you can control a little bit. That gives you a lot of rope. That gives you a lot of time, gives you a lot of wiggle room. We've all seen bad margins for periods of time, for whatever it might be. Now we can include a pandemic in that, but it used to be IT installs, strikes, fires, floods, you name it. Did we downgrade people for that? Generally not. We didn't have those knee-jerk reactions, and I don't think we will here either. We've been saying that this is a transition year, and we're in strange times, and again, none of us could have predicted what's going on overseas. So I think all of us, and I don't want to put words in my colleague's mouth, we'll try to see that classic, how far out can we go without being ridiculous in terms of timing, 20 years. But we're definitely going to give it some time to see, is there a new leveling place that seems permanent? And if it does, then you might see some rating actions at that stage of the game. Otherwise, I think there's a lot of flex on the margins here.
Yeah, and I would just add one thing is that when we, to go back to the downgrades we've seen, it is when the operations have started to eat into the balance sheet. And that, it's just
a lot of fat. When you cut the fat and you start going into muscle, that's a different thing. Absolutely.
Well, what's interesting, I think, Susie, you were going there, is that still fiscal year end matters during COVID, right? I mean, who would have thought we were agnostic to a year end date? And, those with June 30s coming out of a deep labor issue right now may have a tougher time than, say, we'll see December year ends. So something. Yeah.
You need and reverse for last year, right?
Yes.
Right.
Exactly.
I've never been so. Last couple of years or 3 years, however long this has now been. I can't believe when Robert was introducing this and saying we've been doing it for several years. Just that quarter by quarter, just hanging on to that, because we're anxious to see how deep is the cut for a lot of these places over this first quarter. So also that focus on those is important still.
But I think the report you guys did, and I'm sorry, I cut in, I apologize, but it showed, look, the worst month was January. It got better in February. We do expect March to look a little bit better. And what we've heard time and time again is when we're in that surge, everything's going wrong for you as a hospital. You got too many COVID patients with heavy staffing needs, obviously. your staff is sick and out, and you need higher amounts of staff at higher dollar amounts. And oh, by the way, the high profit, yes, we can say that word profit, business is not coming in because we're full of COVID. So there's an inverse proportion of COVID and then your surgical or electives. And oh, by the way, my expenses are at all-time highs. And what we hear is like, I hurt in the surge. Everything else, when it's normal, I do just fine. So it's kind of feast or famine with like a 1 month conversion period between you go from surge to not surge. So I think you hear us all saying just a little bit, we're not declaring that this is going to lower all of the ratings in any way, shape, or form, but we definitely have to see, and I think Eva said it right, how the management teams respond and get used to change, and does that become part of your daily breakfast? And if it does, you're going to handle this a whole lot better than folks who stick in the mud, so to speak.
Right.
So we have a question from someone in the audience, and I'd be curious to get your thoughts. Do you see any geographical differences across the country as you hear about labor challenges?
I do feel like some of the growth in some of the markets, like if you're talking Texas, North Carolina, Florida, like it does mask a little bit of the challenge that maybe a place like Illinois, right, where there's a lot of out-migration going on, does impact on the labor side, for sure. I think we've seen a little bit of that.
Yeah.
Robert, I'll throw something out that I think has been interesting, to me at least, has been, I've been doing this 20 years, we were talking about this earlier, and for my entire life doing this, it's been labor unions bad, and free is good. And the reality is that during this, union organizations have actually done better on the labor, because a lot of the union organizations, those folks do not want to leave and give up their seniority to go join an agency or go do travelers. That's something they do not want to do, and give that long fought seniority up. So they tend to sign contracts, do a whole lot better than one might just sort of intellectually think. And those organizations that are free, if you will, there's a lot more give in and out of the working pool. And so people leave for a while, come back, leave for a while, come back, and hence your agency and overtime goes up. So that one's been a bit of a twister in my head to figure out, but that's been a definite trend that we've noticed.
That's really interesting. Thank you. Okay, Lisa, you want to talk?
It sounds like, let me skip ahead for a second. It sounds like in rating meetings, we're all COVID weary, but we still need to talk about COVID. Is that correct? Does everyone, panelists, agree?
Yeah.
Susie, you wanna? Go ahead.
Sorry. I think we want to, again, understand how it may, especially like when you have that surge of Omicron, how it impacted your labor and the agency costs, and have they started to come down, or is it, they've burned out and you've lost a lot of folks. So I think from that perspective, certainly we want to understand it going forward, and the impact of it. So, and as it kind of comes and goes, like how you're managing other volumes. And I think most of the systems and hospitals that we've talked to have been able to do that in a sort of more normal COVID range, for sure.
Right. And how you're adapting, what scenario planning you're doing, and what your strategy is around those searches, I think.
Like it or not, COVID has been a litmus test for management teams, and it's a real life one we've all lived through. We can watch and see and how people responded and gauge what we think they can do in the future. No one likes to talk about a pandemic, but it is a very good example of how good management teams did or did not respond.
Right. So one cannot say the word pandemic and not think, healthcare social issues, which brings us to our next topic we want to discuss, ESG, environmental social governance. We know all three agencies are focusing on this a lot. So we thought it would be helpful if we go around the Zoom room here and get a brief outline or update from each of you about what you're looking for ESG, what you want to see in these meetings regarding ESG, and does the absence of a crystallized ESG present a red flag for you? Kevin, let's start with you.
Yeah, it's interesting. If you had to pick an industry that was already sort of embracing this before it became, popular, if you will, it was healthcare, it was hospitals. And, all of us go back many, many years. And one of the first things we did as an industry was socially responsible investing. We don't invest in Smith & Wesson or tobacco companies or all of these things. And we've been doing that for 25, 30 years now. And that, I think, is the first tell that you see. And look, I'm of a certain age. I can remember when it would be in the nightly news sometimes that they found medical waste or files on the highway, kind of a thing, the garbage stuff. That doesn't happen anymore. That's just way in the past. So when ESG started coming out, and we do focus on them, just as you say, environmental, social, and governance, we tend to spend most of our time really on the S and on the G. We don't really have E so much to speak of. We can talk about climate change if you like and get into more depth there, something we're concerned about, but it's also very hard to penalize something for an earthquake that hasn't happened yet or a flood that hasn't taken place. Do we want to make sure you're prepared? Absolutely. Would I necessarily downgrade someone because they don't have a flood plan? I don't know if I would downgrade you, but I might not upgrade you. And maybe that's the same thing that you're thinking of. But for the most part, it really deals with articulate what you're doing and get us comfortable that you are comfortable. And like I say, most of this has to do with governance. And I'm going to call the biggest thing when we talk about the S is social, is employee well-being and having a healthy, stable workforce. Obviously, we've been talking about labor all of the time. Is that S or G? To me, that's more G these days because it has to do with your governance structure. So I will also say, last thing, I'm kind of babbling about this a little bit because it's all intertwined, right? So I struggle with saying, well, what was it? Was it the bad governance that led to the bad financials? Was the bad financials causing more of the bad governance because one bad decision made another bad decision? It's all wrapped in, together. And we really like to say the ES and G is probably your proof in the pudding that if you don't have a policy, you don't follow that policy, you don't believe and work to it, you're very likely going to have some bad outcomes. And so we like to see that at least you've got that foundation there, so to speak. And look, if something bad happens, like Omicron, that's out of your prediction, but are you going to respond to it quickly? Probably. And so I think that's a lot of the ways we're going with it these days. Certainly we can talk more, but I don't want to hog any more time.
That's good. Eva.
Yeah, I think the question of will the absence of strategies drive downgrades or absence of ESG strategies drive downgrades is interestingly put, and I would just echo Kevin that it already does. If you don't have strong governance, if you don't have strong financial policy and management, if you're not on top of your social issues and managing to the demographics you have and the regulatory pressures you have, then you'll fall behind your peers. So to that end, yes, absolutely, it's already driving downgrades and upgrades, as we like to say around here. It's already baked in to your rating. So it's not something new, but what is new is that we're trying to articulate very specifically and be very transparent because investors want to hear this. How exactly are we looking at ES and G? How are we breaking it down? And how does this organization rank compared to its peers on ES and G? And so, this year from Moody's, we are going through the exercise of scoring across 15 to 20 different ranks of, what how each hospital ranks for ES and G. So everybody can expect to hear a lot more from us and from us directly on specific ranking and ESG scores, and those really should already reflect what you're hearing from us in our calls and what you're reading in our reports. And we look forward to a lot more conversations on this subject.
Got it.
Yeah, so like everyone, a lot of the ESG risks are already built into our analysis. We've already been doing it, and like our friends at Moody's and Fitch, we're also trying to create more transparency around each of those, given the investor interest, and outlining that a little bit more clearly of how it interplays with the analysis and whether it's above or below the sector, our view of it. And I would say, in terms of, again, we've been evaluating these. I think some of the newer ones like cybersecurity certainly are making more of a headline there. And as it comes to like the environmental aspects, I would say we do factor those in. And when events happen, we certainly want to understand sort of what's in place, what kind of plans do you have in place. And so that is something that we're getting a little bit more visibility on. And I would say from a rating action we have had a credit where they were having a number of floods, year after year, the hurricane, and we just felt that there needed to be a little bit more balance sheet flexibility to weather those, more what seemed to be more frequent storms, more frequent events. So that has come into play. And I will say that in terms of where we're headed, like I said, we already kind of outlined within our write-ups some of the discrete sort of ESG factors, just again for the investor interest. And we are also rolling out what we're calling our ESG indicators in public finance this year, going through this year and next year. We just rolled out our ESG indicators for states last week, and they are there to isolate basically the magnitude of the specific ESG factor or influence on the credit rating through a scale, a numeric scale. So, we are anticipating that we'll be doing this towards the second half of this year, towards the end of this year for healthcare. So, like Eva, you'll be hearing more from us on that. We're not anticipating any rating changes related to that. Again, it's just more transparency and the impact of those factors in a more isolated way on the credit.
Susie, would you like health systems to create or have a specific ESG section in their presentations to you?
So I think what would be, again, I think a lot of the social we end up talking about as part of our credit discussions, when there's labor issues or, the demographics of a service area. So I think a lot of that gets covered. I think maybe some of the things that would be helpful on the cyber, especially as we're learning more about that, we do want to understand preparation, kind of response and recovery, and just, again, I think goes to maybe what Kevin said. We want to, help us get comfortable with how you got comfortable. So what investments have been made? What are you using? Are you using external auditors, certification? How did you get comfortable? How did your board get comfortable that this is a little bit, that you've been able to manage the risk? It's never going to be a zero risk, but certainly here are the things we put in place. How did you determine how much insurance that you should have for cyber? Just giving us that thought process, I think, gives us a sense of how the organization's preparing and thinking about risk overall. And I think for particular credits, if there's certain factors that are more salient, certainly highlighting those and what's in place. So if you are in a flood zone, if you are in a place that's had a number of hurricanes, what have you done? What's your city doing? Maybe a one slide would be helpful just to understand those and the investments that have been made to help minimize the risk and what you're doing. So I think it's sort of case by case and what really matters for that credit. And then one last thing that would be helpful is just overall enterprise risk. Like how's your organization thinking about that with so many complex risks now on the table? Maybe it's helpful to spend 5 minutes kind of covering that.
Got it. Let me ask Eva, Kevin, anything to add on ESG, what you'd like to see in discussion slide decks that Susie didn't mention?
No, I agree with Susie. I think we're covering it already, mostly. Go ahead, Kevin.
I agree with Susie. The one thing we didn't talk about, DEI initiatives, I think that's really come to a higher level. Again, I think all of our issuers are doing it already, but hey, let's put a slide in there. Let's talk about it just to make sure we can check it off our box and you can check it off your box and we understand what's going on. Yeah.
Okay. So it sounds like here's a twist: true or false? Is it a true statement that the long-standing traditional metrics, liquidity, balance sheet metrics, margin, will continue to be where ratings are grounded? ESG is just a part of that analysis. Is that a true statement?
Yes.
Traditional
true.
Credit analysis days. Okay. So for everyone who just dialed in and can't see, everyone's nodding their head in agreement with that. Okay, Robert, over to you.
Unless we change our definition of what a rating is, right?
Yeah.
It's repayment on time and in full. So not if you do it with a smile and don't poison the economy. We're never going to get away from it. We shouldn't, at least those definitions.
Got it.
Well, let's turn to a different topic and talk about strategy for a little bit, if we can. Susie, I'll start with you. In the fall at our HLC conference, sorry, there's an echo. I don't know if there's what we could do to fix that. But in the fall at our HLC panel discussion, we talked about how providers who had a health plan effectively saw that as a hedge against COVID-related challenges. Do you foresee systems going into the insurance side of healthcare more so than they already have?
So it's interesting. We are hearing a little bit more, and I'll maybe go to that in a second. But I think we think that healthcare systems and hospitals have learned a lot from the time of the ACA and not jumping feet first and taking, a more measured approach with appropriate guardrails and expertise in place. I think we think that those hospitals and healthcare systems have learned that, seen what happened back around, when the ACA was rolling out, and folks got in there and jumped right back out when they saw how difficult it was. So we do think it's definitely, but at this point we have more data, we have more technology, we have more credits that have done a little bit more around risk, baby steps. And so it does seem to be more measured. We do hear more about credits trying to get into that Medicare Advantage space, sometimes through partnerships with existing health plans, sometimes, starting to think about doing it on their own. So, we are asking more questions around that and, what's in place? How do you ensure that this is going to be successful? What are you biting off? What are sort of the guardrails up? So a little bit more, and then certainly that continued trying to take a little bit more risk where they can on plans. But we don't see full on. We're going to open up a health plan. I haven't heard too many strategies around that at this point, but certainly getting more in that Medicare Advantage and some of the risk on some of the commercial side where they can is what we've been hearing.
Great, thank you. Kevin, question for you. Talk about digital and telehealth. How much are you hearing about that, and what do you think the impact would be on inpatient volumes, if any?
Yeah, good question. I think it is a growing focus of hospitals, health systems these days. And look, we all went through that period where we kind of shut down a little bit in 2020, and we went from 0 to 60 using the car analogy for digital health. 300 million Americans suddenly decided it worked and it was okay, and the health system stood those things up really rapid, really fast. Obviously, it has come back down, and it's a smaller amount than it was when it was at its peak, but I think it grows from here. And I think it becomes a strategic focus because of two things. One is convenience, access. So access is, a multifaceted issue. Physical access, cost access is one we don't talk about a lot. This is cheaper for people to do, easier for them to do, higher quality when you remind people about their meds checks, their visits, and don't forget to come in for this test, which is what we're trying to do to begin with, and certainly good for population health. But I think it's suddenly become part of the normal negotiations with payers as well. Look, you can pay us for an inpatient visit, you can pay us for an outpatient visit, you can pay us for a digital visit. You're going to pay us one way or the other. We're going to negotiate something. And this is a way for us now to alleviate some of those staffing concerns. You can have lower level folks doing more of these visits than you can inpatient visits in an inpatient hospital or in an outpatient model, so to speak. So think of the efficiencies, right? I can do probably 5, 6, 7 of these things in an hour very quickly on my tablet, on my phone, or whatever it might be for quick follow-up meds checks, stuff like that, versus coming into the doctor's office, wasting 2 or 3 people's time, cleaning the room, disinfecting the room, checking me in, checking me out, sanitizing this, sanitizing that, for the same thing. So I can get that economies of scale. I can certainly get a pricing differential on the staff doing it. And we're going to have to sort of reinvent ourselves and grow this particular piece of the business. So yeah, I think it's going to be huge going forward, Robert.
Any other, noteworthy changes you see to the overall business model? I know there's a lot of talk about home care. I'm just curious what else you're hearing about.
I would venture to say everybody's going to talk about everything, a lot more home care, and again, that gets to the right care at the right place with the right people. And again, if you don't need to be inside a hospital, don't be inside the hospital for all of the reasons we can come up with: the traffic, the parking, the time, the exposure rates, all of that stuff. But the cost, and we don't really talk about that, but the cost is a huge one. So I think that will obviously continue to grow as well. I think other technology we'll see is, kind of like the EICU technology that was all the rage a few years ago, kind of fell off, but I think you'll see that come back again, be more like in the room electronics. So instead of having sitters in rooms all day long, we'll put a camera in the room. If the patient looks agitated, might be getting out and need something, you send someone in from the desk. You don't have someone just sitting there all day long eating that expense out. So I think all of these kind of tech innovative things, there's a fine line between innovation and strategy. Strategy is when you do it to yourself, right? Innovation when it sort of gets done to you, that's disruption. So we're going to see people innovating and trying different things, failing fast, I think. And if it works, let's do more of it, more of it fast, get it out there.
And interestingly, I think just to add, I guess, onto that, there is that potential, for, when we talk about the EICU, using some of the digital technologies to help in that, and then maybe hopefully creating some efficiencies around staffing if staffing becomes a pressure. So sort of that care delivery model, the evolution of that through technology and digital health may, there may be some things out there on efficiencies as well and helping on that side of the model, as well as just overall better care and all of those things, of course, that we want to see too.
Definitely, that's helpful. Susie, if you would, talk a little bit about what you're seeing with respect to consolidation activity. Do you think that'll continue? Is that something you're seeing more and more of going forward?
Yeah, it's interesting. Depending on how long, what sort of the duration of some of these expense challenges are, supply, the inflationary pressures, we could see some, challenge providers kind of thinking, looking to M&A to help offset that more in that traditional kind of sense. And, of course, whether the FTC will allow it is, of course, another question. And they certainly are, seeming to be positioned to provide a little bit more scrutiny. That said, we certainly have seen two big, I should say, consolidations happen over the last month here and more recently. And those are those regional plays looking more for value of, maybe some diversification strategies, maybe growing thing, not just the traditional kind of try to, get better efficiencies and expenses, but more what can we do as a bigger system, more lives under us to, kind of explore different types of innovation there and use technology and data and other parts of our business to grow. So I think those could continue, but, will it be at the same clip as we've been seeing? I mean, those are harder to kind of bring together. So maybe, we'll see maybe some of those kinds of things happen just as trying to compete with the big Uniteds and Optums and those of the world. But will there be a lot of those? It's hard to imagine that because those take a lot to pull together. But maybe those smaller hospitals, and I would say a lot of markets are already consolidated. So again, the FTC is going to be looking at, can you do that consolidation within a market? That's why these other two that we've seen that have been successful, crossing markets, crossing across markets. So we think we'll see some, continue. It'll be the kinds, I guess, that we'll see that'll be interesting. Kinds of consolidation.
Eva or Kevin, any thoughts on that?
No, I mean, generally I agree. There are still some small independents out there that I'm sure are taking a good look at that independence and figuring out whether it works for them through this type of cycle.
Yeah, no, I agree. Nothing to add.
Any observations on the disruptive impact of private equity? No, okay, give that some.
Like if it goes to the, like the ones that I sort of think are interesting, and we'll have to see where they go is, like the Optums are investing, right? And that's not private equity, but the Optums are investing in physicians and primary care and specialists in that piece. The private equity, to the extent that they're investing in some of those physician models or urgent care, and again, taking away some of that outpatient, it's sort of the low-hanging fruit in some cases. But if you're starting to get into the physician side, is that going to move volumes in a certain direction? That becomes the question. Like, will they have more control over, we don't want our patients to go here, we want them to go there. And obviously that's not exactly how it works, but if that steering kind of happens, that, that could be kind of an interesting thing. And if that's where the private equity money's going.
Great. All right, let's pivot again. Let's talk about balance sheet management. Kevin, as you said, it's one of the only things it feels like we can control. And so I guess a question for you first, maybe Eva, are you seeing borrowers ramp up on capital spending or hold back with inflation, labor, supply chain, et cetera, recoupment of MAPs? What are you seeing as it relates to capital spending?
Yeah, I mean, it is a total mixed bag here that we're seeing. I'm sure others agree, but definitely conflicting trends. Some are, taking advantage of that real balance sheet strength, that, kind of unprecedented balance sheet strength to deploy on strategies that they've been holding on. I think, overall, the investment in bricks and mortar continues to just be slow. And I do think one benefit coming out of the pandemic is we're seeing a lot of management teams take a step back and being much more deliberate and intentional and really thinking through, that use of their balance sheet. So I really commend teams on that. I do think certainly some deferred capital that, can't be deferred much longer is going to come back online. But really it's just, and I will say that I have heard a couple of cases just in the last couple of months that, they thought they were going to go this year and they said, you know what, this year this was so bad, this past quarter so bad, we're going to hold a little longer. So really mixed.
Well, and it's interesting because sometimes I hear that and I sometimes hear the opposite, right? That if labor challenges persist, maybe now is better because things will be tougher in the future. It's fascinating. Kevin, question for you. As you think about what you're hearing, how are hospitals thinking about liquidity, access to capital, and investment allocations, given the whole state of affairs? I know that's a very large question, but I know it's on everybody's minds. I'd be curious to get your thoughts and what you're hearing.
Yeah, I think in general, liquidity is probably, and I'm going to piggyback on some stuff that Eva said, is a little more desirous right now than it used to be maybe a few years ago. So, if you go back in time, like we had the markets have a problem back in 08, 09, that was a liquidity crisis. And when COVID reared its ugly head, boy, we were not going to have a liquidity crisis. We know how to deal with that. And look, we took out lines and, we ramped up our balance sheets and then fortunately, the government kicked in and did its part and all that sort of jazz. And we were sitting on all-time highs on liquidity still to this day, even if you strip out the MAP funds. And I think that's something that we like as an industry. It's, I've been saying this for a while now, every dollar is just a little bit more precious than it used to be. And as Eva said, people really taking a deliberate approach to spending it. So I do think that, balance sheets, liquidity will remain kind of at these higher levels. We've seen a few folks, capitalize their balance sheet a little bit up until real recently. There's a sale on debt and people doing a lot of taxable debt for whatever I might need it for. And sometimes it might just be sitting on my balance sheet for a while, and that's okay too. So I do think folks will keep this liquidity, keep it up there, make sure we're getting through this crisis, pandemic, as we move into endemic and it doesn't throw us another curveball. But I also just think people really like, again, that flexibility that it brings. And you know what, if I need to spend and deploy, get ahead while everyone else is hunkered down, I can do that. If I'm one of those that needs to hunker down, then I got the balance sheet to live off for a while if my operations are suffering. So I think that's a sea change for us a little bit.
Yeah. Eva, to that end, do you have a sense, or how do you feel like the industry is prepared for the next health crisis or a recession, et cetera? I'd be curious to get your thoughts on that.
Yeah, I just think it's incredible how agile and adaptive these teams have been. It's been really, we're really impressed with how management has come through this kind of perfect storm of things, and we've come through it with really strong, we've saying it over and over, incredibly strong balance sheets. So to that end, I think absolutely, kind of more prepared than ever. But I do think pandemic fatigue is real, and I think it's, especially for this industry, these frontline folks, it's nobody wants to be in triage mode all the time. And so, hopefully the next hit is not soon. And, I think that just means it'll be all the harder to manage through. But yes, overall, well prepared.
We're starting to get a little short on time, so I want to turn it over to Lisa and maybe have you talk a little bit about rating process and presentations.
Yeah, I think our audience would love to have some key takeaways, actionable items from our session today. So we always get the question, what do the rating agencies want to see in the presentations? So Susie, let me start with you, and maybe specifically, if you can answer that question, but also, are you starting to see projections go a little bit farther out than, say, quarter to quarter, or 1 year in the horizon? Are we back to 2 and 3 year timeframes?
Yeah, no, I think we still want to hear the same things we've asked about in the past. We want to understand the strategies. If they're the challenges around labor, we certainly want to understand kind of how the thought process, because like I said, we said earlier, it is uneven and it's going to affect different organizations to a lesser or to a greater degree. So really understanding that piece in particular right now would be helpful, and what the offsets are, what the discussions with the payers are like. So, but it's all the usual things that we would discuss. In terms of the, we have ever since, probably beginning of 2021, we've started to see 1 year, 2 year kind of outlooks in terms of performance. And I think part of that, especially if there's capital spending, like how are we going to source it? So we are seeing, 2 to 3 years. I know it gets a little fuzzy after that, but we certainly are starting to see that a little bit more on the financial forecasts and sort of thoughts about capital spending for sure.
Okay. And anything big picture, Kevin or Eva, about what we're not including in presentations that you want to see?
We spent the last 2 years talking about COVID, and to a certain extent, I got to be honest, I'm a little tired of talking about COVID myself. But I think that's something that's still very germane. I mentioned earlier that it is sort of a case study that we've all walked through. What have you learned? And what I'd like to hear is, like, what are you doing differently these days because of it? What's changed? Strategically, your market, how has it changed? What processes have you done differently? But also, and this is piggybacking off Susie's, when you're doing your forecasts out, what's the house view? Is the house view it's endemic? A house view we're going to have another big surge, and that informs us how you're budgeting a little bit and how you view the future itself. So, the last couple of years, depending upon where you were in a surge, that radically impacted your budget for the next year. If you're getting crushed by COVID, you're like, well, next year's going to be horrible too. But if it was the summertime and everyone's taking off the mask, you're like, everything's great. So you're a little more optimistic. So I think we have to talk about it just a little bit still, unfortunately, to hear what the mindset is and how you changed and what's going to change in the future. Bit of
just assumptions overall would be is helpful to have that.
Yeah, I totally agree with everything that's been said, and on that assumptions, it's kind of, what's your best case scenario? What's your worst case scenario? Really let us into that room of what scenarios you're discussing, and that just really helps give us a bigger picture.
Right. And I think our clients could talk all day about cyber, right? We're just scraping the surface. Eva, let me ask, what specifically to cover on cyber that you want to hear?
Yeah, I think Susie said it best. Tell us your strategy, tell us where you're investing. I mean, concretely for Moody's, we're looking at governance and reporting structure. Who have you hired? Who's on your board? Who do they report to? That's very concrete. Operational risk management, what systems do you have in place? And then risk transfer in terms of, like, are you on the cloud or do you have cyber insurance? I think, if we could just drill down to those 3 things, it doesn't have to be a long presentation, just, kind of those are our top.
Okay. And are you finding in general more are purchasing cyber insurance in general? Is there any databasing trend yet?
I would say that's a trend. I think, everybody's aware that this is an issue, and so generally we're talking about it, whether it's in the presentation or not. And
got it.
Yes.
Got it. Okay. We just have 2 minutes left. Real quick lightning round. If you were to pull back the curtain on rating committee, right? I'll go around the horn. What is getting the most focus right now in rating committee? Kevin.
I think it's what happens next. What comes next. That's probably the biggest discussion point. What's budgeted versus what we think is going to happen versus what maybe other people in the market are telling us. So it's next year. What happens next year? That's what we talk about probably the most.
Okay, Eva.
Yeah, I'd just add exactly that, strategy and how it plays out in your fundamentals.
Okay, Susie.
Yeah, all of that, and capital spending strategies as well, and how that's going to get sourced with pressures on the cash flow.
Robert, back to you.
Well, I think we're out of time. Thank you so much. We really appreciate it. I wish we could go some more. We have more questions. We got some in over the transom. We intend to do this again, and so look for that to pop back up here over the next several months. Again, we're grateful for everybody's time. We're grateful for our panelists joining us today. Thank you so much. And we will look forward to reconnecting again in the future.
Sounds good. Goodbye, everybody.
Thank you.
Thank
Thanks,
you.
everyone.
Thank you.